Okay, ladies, gentlemen, boys and girls, we are excited for tonight's training, man. I'm excited. I can't speak on behalf of all of you guys that are in here, but I'm fired up for today's training. We just went live on YouTube as well. So in the event that this call does max out on Zoom, people that are on YouTube are going to be able to tap in as well. But guys, I am very, very excited for this training tonight. And I want you guys to real quick before we go ahead and get into the session, drop in the chat where you are tuned in from this evening. Where are you tuned in from today on this beautiful Wednesday, right? We got Wyckoff Wednesday. You guys know me. I do always be enjoying the little word plays. We got like Freestyle Friday was a previous session I used to do. I used to do Monday markups, TA Tuesday, technical analysis Tuesday. Wyckoff Wednesday today, baby. We got Sniper Sunday. Man, I used to do all these crazy, crazy high level trainings back in the day, and we still do a lot of trainings of live sessions, but I haven't done a session, and I'll tell you guys why I'm so excited about this. I have not done a session on this particular topic with slides ever before. I've never done a training quite like this one in the past. So I'm very excited for you guys to experience this live. It's really cool because there have been trainings that I've done over the years that let me actually go ahead and do this. Let me show my face real quick. What is good, guys? Can we appreciate the stash for a second? A lot of you guys have never seen me without the goatee. I made a decision today. I was like, man, I'm so fired up. I'm shaving the goatee for the call. Crazy, right? Who would have thought? Let's go ahead and start recording this thing. But I'm very, very excited to be here. Shout out to those of you guys that are tuning in from all over the world. We got Jesse, Manitoba in the house. Let's go. Australia. It's got to be like 9, 10 in the morning over there. What's good, Jordan? Good to see you. JP tapped in from Calgary. We got Cochrane, Alberta. What's good, Brad? Chilliwack in the building. Mikey, good to see you. We got Bosnia. We got Brisbane, Nigeria. Lincoln, Nebraska. What's good, Luke? In the bunker at the chasm. It's good, Jeremy. Good to see you from the bunk. Blessing from Nigeria. Let's go. Serbia in the house. We got Jamaica. Good to see you, Camille. We got Kitchener. Let's go. Hometown. Shout out to the hometown one time. Good to see you, Grace. It's good, Blake. We got Hospital. Damn, I hope you're good, Ty. That is an interesting place to be tuned in from the talk about dedication, man. Wow. I hope everything's good. I pray everything is good. I'm sending you positive energy and love. Somewhere between Calgary and Kamloops. Let's go. Dayton's on roads. Let's get it. Gabe, what's popping? Alden's tapped in from Montreal. Me too, brother. Me too. Well, Longueuil to be exact, but we call it Montreal. We round up. Hungry in the building, North Carolina, California. What's good, Ashley? Good to see you. We got UK. It's got to be late in the UK. It's got to be like midnight. We got let's see, Plantation, Florida. My brother Barack, good to see you. France, and your French is good. You could teach French in the next maybe in my next life, I'll speak French. Nah, I'm playing. I'm playing. I'll get to a point where I can teach French at some point. Khalil's in the building. What is good, brother? What is good? What is good? Big stash guy. Yeah, for sure. For sure. I had some interesting comments from my buddy Tommy on my Instagram live when he saw the stash. He's like, "Whoa, you look like that one guy that did the thing." I was like, "Wow, wow." Maybe laugh. Looking fresh, brother. Kamloops in the house. Let's go. Ghana. We got Landon's tapped in. Let's go. What's good? Good to see you. Dublin, Ireland. San Antonio, Texas. Kevin, good to see you, brother. Ontario, what's good? Marcus, good to see you, man. We got people tapped in from all over the place. But ladies and gentlemen, without further ado, I am fired up to be delivering this training. I was mentioning it a little bit earlier, but I have never done a training like this before. There have been trainings that I've hosted, that I've shared, that have actually gained traction unbeknownst to me and gotten thousands and thousands of views on YouTube despite being an unlisted video. I did a training in 2019 on market structure that blew up. It was shared across hundreds and hundreds of different communities and got thousands and thousands and thousands of views without me even knowing. And this is a training that I really do believe it'll be public as well, not an unlisted video, but public. This will be an in-depth training on Wyckoff. And this is a concept that I am very excited to speak about because it was something that really shifted my results in trading. How many of you, just by a show of a number one in the chat, are currently trading in accordance with institutional concepts, smart money concepts, ICT concepts? Just out of curiosity. I'm seeing a lot of ones in the chat. So, this is a concept that when you take that understanding and you combine it with who I truly believe is the godfather of smart money's concepts, Richard D. Wyckoff, when you combine his understanding and his method of Wyckoff with what you already know with smart money, you will see absolutely game-changing results with your risk to reward in trading. I'm confident that this is something that when you apply it and practice it and get to a point where it's refined in your trading, you will go from hitting 1 to 3s and 1 to 5s on a regular basis to hitting 1 to 10s, 1 to 15s, 1 to 20 risk to reward ratio trades like they're 1 to 3s. How many of you guys will be fired up and excited to get to a level of trading where that's your everyday kind of take profit hit 1 to 15, 1 to 20, as opposed to 1 to 3 or 1 to 5? 1 to 5 is pretty good. Risking $10 to make 50, risking 1% to make 5%. It's crazy. I was very profitable and content with my trading until I came across Wyckoff. And then I was like, dang, there's so much more of an understanding here behind smart money and the composite man, which we're going to talk about, that I didn't even know. I didn't know what I didn't know. And when this was brought to my attention, when I was introduced to this concept from a book and a couple of individuals that I do want to give credit to, this completely changed the trajectory of my trading. There were a couple individuals that I'll shout out right now. One of them wrote a book called The Wyckoff Method In Depth, Wyckoff Methodology In Depth by Ruben Villahermosa. We're actually going to be taking some of the information from his book and sharing it in today's session. But he was someone that I was actually unaware of who he was. And the book was shared with me back in 2020 or 2021. And it completely shifted my paradigm in the way that I look at trading because I read the book and applied the principles and the knowledge that was shared in that book and combined it with the information and the foundation that I already had. And I saw a huge shift in my results. Another person that I want to shout out, I haven't heard from him, I haven't seen him, I haven't talked to him in a really long time. In fact, we never actually knew each other personally. He was a mentor to me from afar, was Fibs and Profits. And this is someone who, to this day, has made a profound impact on my trading experience, my trading journey through Wyckoff and his very unique style of applying technical analysis and the understanding of Wyckoff to find these ridiculously precise entries. It's insane. It's crazy. Like we're talking, man, if you think a 1 to 10 is cool, how about a 1 to 50 risk to reward? How about a 1 to 100 risk to reward? Like these are the types of trades that these guys are catching. So when you think about trading, you have an edge. There's an edge that you have in the market. And the only thing that you really have to refine once you get to a point of consistent profitability is your risk reward. Your risk reward. You could have a precision that is consistent. You could have precision that's consistent with an entry model that's consistent. You could have consistent exits for specific risk to reward ratios or typical risk to reward ratio outcomes with your trades. The only thing you really have to refine is how you're identifying the entry on smaller time frames, perhaps with tighter stop losses, perhaps with a deeper, more profound understanding of Wyckoff, perhaps to turn a trade that usually is a 1 to 5 risk reward, 1 to 7 risk reward, 1 to 3 risk reward into something that is 3, 4, 5 times as great in risk to reward. We're talking this, particular individual, Fibs and Profits. I remember learning from him. I want to give credit where it's due. I'm not the mess, I'm the messenger in this. Okay. Even Fibs and Profits was just the messenger in this. Okay. Richard D. Wyckoff is the GOAT. And we're going to talk more about him in a second here. But he's someone that literally would take trades on currency pairs, indices, gold, Bitcoin, with stop losses that you can't even begin to fathom because you've never taken such a small stop loss in your life. We're talking 1 to 2 pip stop losses. We're talking 5 pip stop losses for ridiculous risk reward with such precision, it it almost frightens you how precise these concepts can really get you with your trading. So again, if you're fired up, okay, if you're fired up, right? What's my highest risk to reward? Question in the chat. I had a 1 to 40 on US 30 back in this was around the time that I was learning these concepts. That was at the time my highest risk to reward. Since then, I've hit multiple 1 to 40s, 1 to 50s. I have yet to hold a trade long enough for it to be a 1 to 100, but I have taken trades that would have resulted in 1 to 100s if I had the balls to hold them. Um, sometimes it's easier, to just pay yourself, right? One of the things that Richard D. Wyckoff says is that a profit is not a profit until it's realized. You gotta know when to close a trade. But that's the type of ability that you're going to have leaving this call. Now, it's going to take time. I'm not saying that you're going to leave this call and be like a 1 to 100 wizard where it's like every trade you're taking is just an absolute banger. And I would still encourage, especially those of you guys that are maybe newer on the call, trading for less than a year, to take 1 to 5s consistently. When you get good at taking 1 to 5 risk reward ratios consistently, and then you combine it with this understanding that we'll be sharing today, and you apply it to the fractal markets, which means that the same thing you're looking for on an hourly time frame, 15-minute time frame, you will find on the 5 minute and the 1 minute. That's when you can start to take such refined entries, smaller time frame entries with higher time frame targets and higher time frame bias considered. That's where these really crazy risk reward ratio trades come from. So with that being said, without further ado, guys, would love to see some more cameras. If you're in a position where you can throw it on, we have like 5 cameras on. It's crazy. We got like 60 of you guys in here in the Zoom room. Don't be shy. I'm representing my stash for the first time. I was a little bit nervous. I haven't had a stash without the goatee in a long time. I was like, man, maybe I'll do the session without my camera on today. You know, totally kidding. I would never do that. But don't be shy is the point. Okay. Would love to see some beautiful faces and show me that you guys are locked in. Show me you're locked in. Show me you're ready. You're in a position where you're fully immersed in the training. Because I'll tell you guys this: the information that I'm going to share, number one, didn't create it, just the messenger. Number two, it's not meant to go to you; it's meant to go through you. So take what you're going to learn today and apply it, relay it. And actually, I was just having a conversation with Nathan. Shout out to Nathan one time from Texas, tapped in. We just started working together more closely recently. And I was sharing that one of the things he asked me a really great question. It's rare that I'll get this question, but he said, "Hey, like Donnie, when you started, what were you doing? Like, what was your routine? What was your system? What was your approach?" And that's a great question to ask somebody because you don't want to do what somebody that has what you want has been where you are is doing now. You want to do what they did when they started and do that long enough to get to a point where you can see the same results. And so I said, one thing that I did is I would learn a concept or a principle from a mentor, from a video, from a live call, just like this. In fact, shout out to Kevin Ferguson one time. We've known each other and been in the trading space together since like 2019, 2020, 2021. And he knows. Like we have a lot of the same mentors. I would be on his session or their sessions, the mentor sessions, and I would learn a principle and immediately go ahead and relay it and challenge myself to educate on that principle as a way of gauging where I'm at, number one. And number two, what I need to further refine as a trader in terms of my understanding with that particular principle or concept that I would educate on. That's what I was doing when I first started. I was super locked in. I was any free time that I had was being fully committed to learning the skill, the process, and teaching what I was learning. One of the hacks, one of the cheat codes to really get to a high level in anything is to start regurgitating. It sounds like it's a crazy word. It's kind of cringe when you say that word, but regurgitating what you're learning to others because you're going to see where you need to further refine yourself to be able to communicate effectively that understanding. Because when you can put an understanding into words and take it from here, put it into words and articulate it, that's when you know you've really got it. So I would do calls and I'd be like, just teaching about market structure. Oh yeah, higher highs, higher lows, lower low, higher low, lower high. I would say it wrong and I'd be like, wait a minute, that's not how it's said. I got to go back and watch the recording again. Then I would refine it and then I would teach it again and I would see where my blind spots were or where the areas were that I needed to improve to get ahead. So information that you're gonna hear from today's call or from future trainings, whatever, it's not meant to just go to you, it's meant to go through you. So bring it to others. Challenge yourself to see how you're able to explain the same principles we're going to be talking about today, and you might find yourself with a more deep and profound understanding as a result. So, with that being said, this will be uploaded. It's currently being streamed to YouTube. This will be uploaded in the recorded format and sent out to anybody that registered. There was more than 100 registrants. There's about 70 of you, 67 of you that are on the call right now. So there's many of you that are probably seeing this on the recording. Shout out to you for taking the time to be here on the recording. Shout out to those of you guys, even more so, for taking the time to be here live. And without further ado, let's get right into the news. You guys ever seen that? Oh man, cringe. Absolutely cringe, Donnie. You're crazy for that one. I know you guys are probably thinking that, but I'm thinking that personally. I was out of pocket, man. What are you doing? But Keemstar, man. Big YouTube guy. All right. So welcome, guys. Welcome to the training. What I would appreciate, this is obviously a free training open to anybody. For those of you guys that are on the call live or in the recorded format, feel free to take pictures, to take videos, to take notes. Okay. I would highly encourage you, white paper, blue ink, write down, not just write down, but draw and actually create diagrams for yourself of what we're going to be going over. And do me a favor, post and tag this to your Instagram story. Post it, tag me. My Instagram's Donnie Dropout. Most of you guys came from my Instagram. And we're gonna be here for, like I said, probably the next hour to an hour and a half. I would say be in a position for the next hour, hour and a half to fully immerse yourself. Okay. I know some of you guys it's late. If you fall asleep to my voice, it won't be the first time. Don't worry. Try and stay locked in as long as you can. I've had people actually, it's funny, sidebar, and we're gonna get into it. You guys are probably like, Donnie, just get into the training. We're here for the training. We're getting there, don't worry. I had someone ask me one time, because I have a radio voice, apparently. Uh, I've been told that my whole life. They were like, hey man, could you record some nighttime affirmations for me so that I can put them over frequencies and listen to them while I sleep? I had someone say that to me one time, and I was like, yeah, 100%. I'm happy to. And so I did that. And, you know, I don't know if they still listen to them. I don't, maybe it was just a one time. Maybe they never listen to them. You know what I mean? But I say that because there's literally people that will be on my sessions, almost every session, and literally fall asleep on my sessions to my voice without the frequencies and without the affirmations. It's cool. Weird flex, but okay. The ASMR videos, right? Yeah. Imagine I had someone tell me the other day, they're like, yo, you should do that the next like coming soon to theaters commercial. I was like, honestly, I'm down. Let me know. If you know somebody, I'll do it for sure. Coming soon to theaters. You know what I mean? That'd be a great time. But anyways, coming back to the point, welcome. Shout out to you guys for being here. This like little cool welcome. Look at that. Welcome to today's Wyckoff Wednesday training. Guys, if you get any value from the session, feel free to take pictures, post them on Instagram, tag me. It's at Donnie Dropout. We're gonna have a lot of fun on today's stream. So, first thing that I want to go over. This is what I really truly believe to be the missing puzzle piece with smart money. A lot of you drop ones in the chat saying that you are currently trading in accordance with smart money, understanding how the banks are trading, trading with them, or doing your best to do so. Okay. This is smart money's missing link, what we're going to be diving into today. And the person really that's had the greatest impact on trading as a whole, I would go as far as to argue, in terms of technical analysis and retail traders, is Richard D. Wyckoff. Okay, this is the godfather of smart money. If you don't believe me, allow me to elaborate and edify this individual. Okay, I don't think y'all are ready for this one. All right. Before we dive into the training, okay, it's important that I introduce you to a man whose work has quietly shaped the way Wall Street really operates. Someone who actually pulled back the curtain and knows how the markets actually move. Okay, that's Richard D. Wyckoff for you. If you've never heard of him before, it's by design. It's by design. The institutions don't actually want you to know how they operate. Okay, it's not news, or it shouldn't be a surprise to you that they don't want you to actually know how it is that they're trading. And Wyckoff, Richard, your buddy on screen, was one of the first people to actually crack the code of smart money. He's the first person, practically the first person in history to really crack this stuff. And it's long before there were screeners, indicators, TradingView. I mean, this guy was reading the tape. You guys don't even know the history of trading. Tape reading is what trading used to consist of. It's great. It's not a chart. There's no charts, man. You're reading a tape. Okay. Won't even get into the actual history portion of it, but look it up. Tape reading. He would read the tape and study price action before candlesticks were even made mainstream. All right. And he wasn't just some academic theorist. He was actually in the trenches. Like, this is a broker, a trader, a publisher, and more importantly, someone who actually truly understood human behavior in the markets at a level that no one understood at his time. And it's crazy because what he discovered is still to this day quietly being implemented by elite traders and institutions around the world. In fact, the whole concept, smart money, institutional trading, institutional concepts, the whole movement is a remix. It's not even the original, it's a remix of what Wyckoff was teaching more than 100 years ago. Really take that into consideration. So when we're talking about what we're going to be talking about today, when we learn Wyckoff, you're not just learning some strategy. This is like how to think like the banks at the truest level, at the truest sense of the word, how to identify when institutions are positioning themselves, when they're getting out, and how not to get played as an individual trader in between. So by the end of the session, guys, just to give you an outlook and to encourage you to stick around for the full duration, or at least go back and watch the recording if you can't make it to the end, you're going to be in a position to further understand how exactly the institutions are positioning themselves, how to read accumulation, distribution, markups, markdowns, reaccumulation, redistribution, the different things that Wyckoff popularized. And you'll really be able to align yourself with the real flow of the market. So if you are fired up, okay, for this training, if you guys are fired up, I know the screen's paused. Okay, we're going to bring it back up in a second. But go ahead and go crazy in the chat if you're excited for this training, because this is the guy. All right. Some people tell me like, Donnie, oh, you're the guy. You're so cool. You're this, you're that. I was like, dude, I'm just a chill guy that trades, and I have the best mentors, and I'm forever grateful. And this is the godfather of smart money that every single one of us is trying to mimic without even knowing it. That's what we're talking about on this call. So let's get into it, man. Let's get into it. Let's actually decode Wyckoff. That's what we're here to do today. I'm super fired up, and let's get right into it. Okay. So, first things first, get ready to take notes, right? This is the note taking stage starting now. What actually is the Wyckoff method? All right. Really, quite simply, it's three things. Okay. Number one, it's a system for reading market behavior. All right. It's a system for reading market behavior, looking at the charts and understanding really what's actually going on instead of looking at the charts and being like, what's going on? How many of you guys drop a two in the chat if you've looked at the markets and been like, what's going on? Maybe that's been you with gold over the past month and a half, 2 months. Looking at gold, you're like, when is this thing going to pull back? What's going on? What is happening here? It just keeps making all-time highs. It's like a shit coin. It just keeps going lower, but the other direction. It keeps going higher, right? The second thing is it's designed to track the intentions of the true smart money, the true institutions, the ones that are the market makers that are really doing the damn thing. Here's a misconception. It's not in the slides, so write this down. Okay. Men and women do not move the market. Supply and demand, relevant, but it's not the true market mover. Money is. Money is the true market mover, meaning that price moves because of money. That's it. He who controls the money controls the market. He who controls the money controls the world is another quote maybe you've heard before. So this approach, the Wyckoff method, is designed to track the intentions of smart money because smart money has the most capital, the most liquidity, the most money to influence price. And number three, the Wyckoff method as a whole, it's based on price, volume, and time. These three things are very, very important to understand. Okay, so three basic principles to write down. If you guys are ready to move forward, you have these three written down in your notes. Drop a three in the chat. I want this to be engaging. That way we don't have any unintentional doze offs. You know what I mean? For those guys that are like, I want to lock in for the whole session. I don't want to fall asleep. Totally. I'm just gonna keep joking about that for the rest of my life, man. I've literally like people will literally tell me, I'm so sorry, man. I fell asleep on your session. Can you please send me the recording? It's like, yeah, of course. Of course, man. No problem. Oh man. So there's really four phases of Wyckoff. We're not wasting any time. We're getting right into this. Okay. There's four phases or four pillars, hence the picture of Wyckoff. This is really important stuff. Okay, really important stuff. I would highly encourage you if you don't already have a pen, white paper, blue ink, pen and paper, not just your phone for notes. Okay, we're talking actual note taking, three-ring binder. I know maybe some of you guys like don't even know what that is, because you're just technology. You know what I mean? You want to bring these ideas to paper because it's giving them mass and it will be something that is retained much easier, but actually get to a point where you're drawing down what we're about to be showing on screen. A couple things that we're going to be showing on screen in the form of diagrams. Okay. So first things first. All right, you don't have to feel like you need to draw this, exactly as it is on screen right now. You can if you'd like to, right? If you want to go the extra mile, but focus here. These are the four pillars or the four phases of the market. You have accumulation, markup, distribution, markdown. This is very similar and can be likened to a market cycle. Okay, we're going to talk about that in a little bit. But this is really essentially what Wyckoff is all about. It's understanding the four phases and the types of schematics that tend to present themselves in the market. And again, it's based on also volume. Volume is something that you can look at in confluence with these schematics to better understand, or in confluence with this understanding to understand really where we are at, ultimately where we're at. So accumulation is the first phase. Write down under this cause. Okay. And in fact, if you want to draw this diagram, it's probably a good idea to draw this diagram out in your notes. So Accumulation is consolidation at a low point in price, essentially. You can have accumulation in the middle of a trend, which is called reaccumulation. The markup doesn't always need to have a reaccumulation, but we're in a very bullish environment. It does tend to have reaccumulations along the way. The same way as a distribution, or inversely, a distribution is consolidation at a high point in price prior to a markdown. Sometimes markdowns are just, without redistribution. Redistribution is like that choppy sideways price action on the way to continue lower. But simply put, there's four phases. Accumulation, write down cause under accumulation. Here's why. Understanding the law of cause and effect is absolutely crucial in the market. Okay. The same way that there is cause and effect in everyday life with everything we do, like think of some examples in your own life. Okay. I went to the gym for, I don't know, 6 months, 3 days a week to lose however many pounds. That's the cause. The effect is after 6 months, I lost the weight. Cause and effect, man. The same thing, the same principle. Okay. Accumulation is cause, markup is effect. After the consolidation, we have a move higher. After the accumulation, we have the move higher, which is the effect and is in direct proportion, key point, typically direct proportion to the accumulation higher. This is usually in, to some extent, direct proportion to the actual cause. Distribution is consolidation at a high point. There are certain things you're reading on screen here. You're probably like, I have no idea what that is. Buying, climax, failed rally, test. What is that? We're going to get into that. Okay. For now, you can just focus on drawing the diagram. If you want to put the labels, you can for sure. But the main ones, accumulation, cause, effect, markup, or markup, effect. Distribution, cause, okay, consolidation at a high point, which is the cause for that markdown, which is the effect. Okay. Don't feel like you need to draw everything, verbatim, so to speak, as what you're seeing on screen, but definitely take a screenshot of this. Okay. And you type this into Google, you will find this picture, Wyckoff logic on Google. It'll come up. It's an image. You can save it to your computer, print it off, and put it on your wall. That's what I would do if I were you. That's what I did when I saw this for the first time. I printed it off and I put it on one of my boards. I have multiple boards in my room at home. And there's a board right here actually as well. It doesn't have a schematic, but there's a dream board. Julia's dream board. It's a really nice dream board. But print off this picture and put it behind your trade station, wherever that is. That way it's subconsciously, it's always in your face, even when you're not focused directly at it. It's in your peripheral. And then when you do need to look at it, boom. Oh, what is that schematic again? Yeah, just let me look here. Perfect. Okay, cool. There's multiple schematics you're going to want to print out after this session. This is one of them. So let's dive into it in a little bit more technicality. And before I do, actually, I want to share something. This is not in the slides, so let me pull this up. Let me pull this up real quick. Let me pull this up real quick. So there are three laws in Wyckoff. Okay. Three laws that we should, basically understand. In fact, I have them in the slides here. They're not pretty, but it's in the slides. Put this in last minute. But there's three laws that I want you guys to write down, and we're going to expand on each of these in their own time throughout the session. So law number one is the law of supply and demand. Okay. Price moves where demand is greater than supply. Price also moves where supply is greater than demand. It's the first thing to understand. But again, money is ultimately what is actually dictating where demand and supply zones are. And we'll get into like what is demand and supply. We'll talk about it on the charts in a little bit. We just alluded to this, the law of cause and effect. Okay. The size of the base, also known as accumulation or distribution, determines the magnitude of the move. This is a really well worded description. The size of the base, accumulation or distribution, determines the magnitude of the move. All right. And the final one, also really important to understand, is the law of effort versus result. Volume has a direct correlation and can be looked at as essentially effort. We'll talk about volume, we'll talk about the indicator, we'll talk about, how you can look at it and better understand these schematics in a little bit when we get into some actual examples. But law of effort and versus result. Okay, effort and result, effort versus result. Volume or effort should match price movement result. If not, a reversal might be coming. This is important to understand and to read when you're looking at the charts. Okay. If you guys are good on this and you have this written down, drop a 2 in the chat box. Is a markup and a markdown reaccumulation or redistribution? Sometimes, not always, but sometimes, usually. I'm on Max, so I'm screenshotting. No worries. I would encourage you to have a notebook and a pen as well as beyond from the MacBook. So let's get into some actual schematics. This is where it gets exciting. Okay. Accumulation schematics. Now, before you get like confused and you're like, dude, this is reminding me to when I first started trading, it's like hieroglyphics all over again, right? I just thought I got to a point where I was understanding the markets, and then Donnie did this call talking about schematics, accumulation schematics, and they looked like this. And there's all these fancy words, or not words, but labels. PS, AR, SC, ST, ST in phase B, spring, test, LPS. What is all this? Okay. We're going to get into all this. We're going to explain all this, but understand this is another schematic. You can also find it on Google. Type it in, accumulation schematic number 1, Wyckoff. This is one you're going to want to print out and also draw out right now in your notes and put it on your wall, right by your trade station. You can do it or you cannot do it. It doesn't make a difference to me, but this is what I did. I'm just sharing what I did and what really helped me to understand these schematics and get to a point where it's like I see them. Sometimes I'll mention them on session. Sometimes I won't because I know that the context isn't always there for people. But hey, that's why we're doing this call, to give that context now, right? So this right here is an accumulation schematic type 1, okay? We're going to get into the differences in schematic types. There's actually numerous. There's not just 2. We're only going to go over 2 specifically on this session, but there's numerous beyond 2, okay? But this is a type 2 schematic. Similar, but different. Similar, but different. Again, I've talked about this on sessions previously, but today we're really going to be unpacking in a lot more detail every component of an accumulation schematic. So again, screenshot this, type it in on Google, accumulation schematic number 2, save the picture, print it out, put it on your wall, and draw it out in your notes, right? Draw it out in your notes, man. Just like that, okay? If you want to label them, go for it. You can label them right now and be like, I have no idea what these stand for. I'm just labeling it, you know, or it'll make sense in a second, or you can just feel free to leave it unlabeled and then go back and label it later. Okay. Notice how there's different phases, phase A, B, C, D, E. There are phases in accumulation. Same thing with distribution as well. There's phases. Okay. Phases. So let's actually take this a step further and unpack this because some of you guys are probably like, this is where I'm lost. Okay. You're like, all right, this is, yeah, you know, yeah, this is something. I don't know what, but it's something. Okay. Well, we're going to go right to the horse's mouth, going right to the book that was a big part of changing my trading. This is the Wyckoff methodology in depth. Um, if you haven't already, you can actually get this, the PDF version of this, from me on Instagram. I have a reel on my Instagram page that I will drop in the chat for you guys. Okay, just give me a second to find it here. And if you comment books on the reel, this is one of the books that is sent over to you for you to take advantage of, for you to use. So I believe it's this video right here. Let's see. Yes, it is. Perfect. There's also two other ones as well. Okay. So maybe you have these books and you've read them. Maybe you have them and you haven't read them. But if you go onto that Instagram reel and you comment books or comment book, it's one of the two, books or book, this will actually be sent to you. Okay. It's in a Google Drive, right? You just fill out the form. It'll be something you can download. Told me to take a picture of my Google AI, automatically broke it down. Oh, that's awesome. Here's amazing. Perfect. Cool. It's good stuff. Love to see it. That is the major difference, Jeremy. Correct. One has a spring, one does not. So let's actually unpack the different labels of an accumulation schematic. Again, this is a phenomenal read. If you haven't read this book, I highly recommend it, man. Not for beginners, but it is for beginners at the same time. It's like it's advanced, but it's also like you could pick this up as someone who's been trading for a month and it could give you crazy cognitions and you'll be like, wow, and you'll get to a point where you want to be in trading sooner, right? But anyways, let's actually just go to the meat and potatoes of this. So again, the actual schematic itself, you can see it here. It's labeled. There's no phase labeling, but there is volume labeling, right? I can't annotate it. Let's see. Let's see if I can do it this way, right? There is volume annotated. Oh no, there is phases. I'm tripping. It's at the bottom. All right, but you have all these different labels. So let's talk about it. Okay, accumulation. Write this down. This is by definitions. Okay, definitions. You might look at this and be like, lame, boring. Not going to write it down. Well, guess what? You want to illuminate the definitions. Illuminate means to integrate it and to almost file it in your mind. You have to file it. Okay. So accumulation is the process by which large traders absorb available stock or whatever it is from the market. This is a transfer from retail traders or weak hands to strong traders or strong hands. Very key point. Very key point. This is what we've been seeing over the past, realistically speaking, like 2.5 months on Bitcoin specifically. We're actually going to be pulling this up for an example. It's in the perfect start to phase D right now on Bitcoin, which that alone is like, oh, I should probably buy Bitcoin. Probably a indirect trade signal right there. Okay. If we're in phase D, it usually, phase D is going higher, E is going higher. Well, maybe I should buy Bitcoin. Right? Not financial advice. But this is a key point. Okay. It's a transfer from retail traders. It's a transfer of who's holding whatever it is from weak hands to strong hands. Okay. You have the creek. The creek you can see on screen. It's the more or less resistance of this consolidation range. Notice how we have choppiness. Okay. Choppy, choppy, choppy. You have some sort of a creek or a high resistance, which is called your creek. All right. You have a change of character. All right, the creek, by the way, we'll read this out verbatim quickly. The resistance level for accumulation or reaccumulation structures. It is established by the high generated from the automatic rally. You can see it right here. There's the AR. That's how you know where to draw it. This is an important point. And by the highs that can be developed during phase B. Automatic rally, high in phase B. This is your creek. This is your resistance for the accumulation. It's important to map these out or to understand how to read them and where they are. Change of character, CHOCH, short for change of character. It indicates the environment in which the price will move soon. The first change of character is established in phase A, where the price moves from a downward trend to a consolidation environment. The second change of character is set from the low of phase C to the high, which is a sign of strength, SOS, in which the price moves from a consolidation environment to an uptrend. Take a look at this. Let's break this down. Here, we're in a downtrend, lower lows and lower highs. What happens when we get a lower high, lower low, lower high, higher low, higher high? That is a change of character. It's not a market structure shift because we didn't break above the previous lower high, but it's a change of character. This is the start of an accumulation or the start of a consolidation. It could also be a redistribution to go lower potentially, but it's the start of that consolidation period. Okay. The second change of character comes as we actually get a sign of strength breaking the creek back above the highs of the consolidation range. All right. We haven't even labeled the rest of these, but hopefully this is already giving cognitions. Okay. So in phase A, let's actually go through the labels. Write this down. I hope you guys are writing all this down. To be honest, this should be written down verbatim in your notes. Now it's a lot of writing. You guys are probably going to have blue hands, right? Blue ink. Okay. You're going to have blue hands after writing so many notes. Your mom and dad's going to be like, what? This is crazy. Were you just writing an exam? Your partner's going to be like, yo, wash your hands, man. This is dirty. What you got the blue ink for, man? Get out of here. Are there specific time frames in which this method and patterns are more accurate? You can apply this on every time frame. Totally fractal. Totally fractal. And we'll be looking at some examples of this and how the nature of the market is entirely fractal. It's actually crazy. Like you can look at on a higher time frame perspective. This is a daily time frame accumulation, let's say. Each one of these lows will have a smaller time frame accumulation. It's trippy. It's like, whoa. Okay, I don't want to go too far too soon. We'll get to that. That's a great question. Yeah, you can identify this on all time frames though. All right, the higher the time frame, the more consistent you'll tend to be able to identify these. So phase A, stopping the previous bearish trend. PS stands for preliminary support. Okay, it's the first attempt to stop the bearish movement, the downward movement that will always fail, which means that we're not seeing the reversal. This will always fail. Okay, this is where your preliminary support is. Here you are, lower highs and lower lows. Here you have a preliminary support. We get a bounce, but it certainly wasn't a retracement, and we still melted. Okay, or we still went lower. That is your preliminary support. It's also usually just a sidebar, going to be around the high of your creek. Not always, but usually around the high of your creek. It could be a little bit above, could be a little bit below or within. But you'll see this with examples that we're going to show. SC stands for selling climax. Okay. Climax action that stops the downward movement. So instead of us continuing to break lower, the SC is what actually gives the change of character. Right? The change of character is right here. When we get this low established, then we get a higher high, or sorry, not a higher high, still a lower high in the market structure, followed by a higher low and then a sequential higher high. The SC is what causes this. Usually there's liquidity being captured with an SC as well. Usually, not always, usually. So This is your SC right here, still in phase A. All right. After the SC comes the AR, the automatic rally. This is the bullish reaction, an upward movement that sets the trading range high. Okay. That's your automatic rally. So if we take a look at this, this is, again, this is your creek, right? The creek is established by that automatic rally. The high of the range is set from the AR, the automatic rally, and sometimes the high that comes in phase B. So far, so good. Let me get some ones in the chat. So far, so good. There's some very, very key distinguishing components of an accumulation, of a distribution that I'm going to make sure that we highlight and emphasize. A very important one is the fact that that automatic rally is creating the high of the range and sometimes that high that comes in phase B. Okay. Also, another key point is that that SC will always lead to a change of character and market structure. Not a break of structure, not a market structure shift, but a change of character. Those are three words that people use interchangeably, and they are not the same thing. A break of structure is not the same as a change of character. A market structure shift is not the same as either of those two things mentioned prior. Very, very key distinguishing differences that a lot of people, myself included, I was using wrong for a long time. Okay. Can they be used and understood interchangeably? Sure. But that's like saying, oh, yeah, trying to think of an analogy here I can use. That's like saying that blue is like the same as turquoise. It's like, yeah, like there's sure, but like no, they're different. That's like saying a change of character and a break of structure are the same thing. It's like, yeah, you can maybe see it that way, but it's like they're different. Same with the market structure shift. Moving forward, ST, secondary test. Test of the level of supply in relation to climax action. Establishes the end of phase A and the beginning of phase B. Now, test of the level of supply. So this is something that when we see a secondary test, it's almost like seeing the willingness of price to trade lower, the willingness of price to be bought up, the willingness of the buyers to take buys from the ST. Okay, so it's again, it's going to give the change of character. Typically, we could, obviously we would mark up the schematic differently if it traded lower than the seller climax, the selling climax. Okay, but this is like testing to see, all right, what is the willingness for buyers to take buys and prevent price from trading beneath the seller climax and actually, they're gauging. This is what the smart money is doing. The institutions are doing this. Really important concept to understand. Major banks can't just go ahead and press buy with 100,000 lots whenever they feel like it. There has to be enough money on the other side of their major positions. And newsflash, they are positioning themselves all throughout a duration of accumulation to get their full exposure in the market. It doesn't happen from just one buy to sell or sell to buy. This is a key point. A lot of smart money traders don't even understand this. They're like, okay, here we go. Equal lows, sell to buy. Perfect. I'm buying here. And then they get taken out again. And they're like, what happened? It's like, bro, yeah, that might have been the first entry from a major institution, but bro, that's the seller climax, selling climax, man. We still got two waves lower potentially. Noob, right? Okay. I'm telling you guys, this is the missing link for a lot of smart money traders. When you understand this, this will completely revolutionize your trading for real. So let's continue. All right, let's continue. ST, last part of phase A, key point. Phase B, construction of the cause. Can we just get a 2 in the chat for the way that that was written? Construction of the cause. That almost gets me as fired up as Wyckoff Wednesday. It rolls right off the tongue. I'm having way too much fun right now. Don't get me in flow state. We have way too much fun. So, the construction of the cause. The first portion of this, usually I don't actually label this, but you can, is UA, up thrust action. It's the temporary breakout of the resistance and re-entry into the trading range. This is a test at the high generated by the automatic rally. So here we are. Price is trading lower. We've created that preliminary supply, the preliminary supply. Here's your seller's climax. Automatic rally. ST UA. UA is breaking above the automatic rally, only to then very quickly return into the range. That is the high of my accumulation range, the resistance, the creek. We take a look at it in this example. You have the UA, and then very quickly we return back into the range, and we get what follows, which is ST as SOW, secondary text as a sign of weakness. All right, we'll continue. ST as SOW. So secondary test as sign of weakness, or you can just put STB. ST in phase B, STB. All right. Secondary test as sign of weakness. Sample of weakness in test function. Temporary break of the support and re-entry into the range. So it's almost the same thing, vice versa. It's like here we have a trading range. Okay. Your up thrust action temporarily breaks to the upside and then comes back into the range. The same way as the ST in phase B, or ST as SOW, sign of weakness, breaks to the downside just to trade right back up into the range again. This is a test at the low generated by the seller's climax. So if we take a look back up here, we are getting our first liquidity capture with an ST in phase B of the accumulation. There's probably already liquidity that's been captured on the way down. But in this accumulation that's taking place, consolidation at a low point, we are getting our first liquidity capture when an ST is made in phase B because it's taking out the low of the SC, which means anybody that was buying here gets stopped out, including a ton of smart money traders. A lot of smart money traders. Easier to see this with the line chart instead of candlestick chart. It could be, for sure. For sure. You'll get so good that you can train your eye to see this both ways. And the examples that I have actually show just candlestick charts. Because sometimes the wick will tell a story that the candle bodies don't, and the line chart only shows you candle closures. So it won't show you the wick. So, but it's true. Yeah, you can look at it both ways. So STNB, sign of weakness, that's the first liquidity capture really in this range. Okay. In this consolidation range. You now have technically two lows that have been captured, but it's the first sweep of liquidity. This is what I call the second drive. There's a principle I'm going to share on this call that is referred to as three drives, the three drives. Okay. Because I'll be honest, what we're going over right now is deep. It will take time. It will take rehearsal, if you will. You're going to have to apply this. You're going to have to do a ton of back testing. You're going to have to review your notes, rewatch the recording. And this particular principle that we're going over with all the different labeling and stuff is going to take you time to learn. The three drive approach is something that's a little bit easier for you to understand. And it's the premise and the principle that there are three motions in any accumulation prior to a move higher. So you have the first drive, which is the creation of the SC, second drive, which is the ST in phase B, capturing liquidity of the first one. And then you have the third drive in an accumulation schematic one, where you're getting another sweep of the ST as a sign of weakness as a spring, the final liquidity capture, the final hurrah before we trade higher. And you'll see a lot of examples that I'm going to show you guys of actual charts. They are very easy to identify as three drive patterns, where you get three drives, one, two, three drives, and then price reverses, goes higher. Okay. So moving forward, that's basically phase B for you. Okay. We get the upthrust action, which is sweeping highs. We get the ST as SOW, which is sweeping lows. Technically, both sides are being, there's liquidity being captured on both sides. Okay. Phase C, all right. Construction of the cause in phase B. Phase C is the test. All right. Here we have basically, and notice how small phase C is. Phase C really is just the spring. And you get a secondary test as well, but really it's just spring. So what is the spring? Probably your favorite component of any accumulation schematic is going to be the spring. Here's why. The spring you will identify as the third drive, which captures liquidity finally, the final time of liquidity being captured, prior to trend breaking higher and reversing. All right. And as written in the book here, spring, it is a test in the form of a breakout of the lows of both phase A and B. There are three different types of springs. Okay. We're going to go over each of them. Mainly, we're going to be focusing on one type of spring, and it's just, one universal spring, but it's good to know that there's three different types. So you have a test spring, downward movement towards the lows in order to check the commitment of sellers. Okay. You have the LPS, which is in a type 2 schematic where it doesn't actually break the low of phase B or we'll say phase B, because sometimes it'll still go lower than phase A, but not the low of phase B. And this is LPS stands for last point of supply or last point of support in this particular scenario. So test in the form of a bearish movement that fails to reach the low of the range. So this is where, if we were to draw this out simply, okay, you have low, low, low in a schematic, accumulation schematic number one. And then price trades higher. Schematic number two, we get low, liquidity sweep, last point of supply or support, trades higher. We failed to take out the low of phase B. Very significant. And Jeremy pointed it out. It was a good eye. When he was looking at the two schematics, he said, oh, it looks like the difference is just one has a spring and one doesn't. Exactly. All right, you'll get an LPS instead. The final type, one of my favorite types, is the TSO, the terminal shakeout or shakeout. It's an abrupt movement to the low, breaking out, that produces a deep penetration of the level of support and a fast recovery. This is like a huge, practically V-shaped recovery. All right. So again, really it's just, if you want to keep it simple in your notes, you have a spring. Yeah, there's three different tiers to it. You can write down the three different tiers, but really there's two that you should focus on. You have spring or terminal shakeout and LPS, which is a type 2 schematic. So if we're taking a look at it in the screenshot here, all right, here you have drive number one that creates the SC. Drive number two, which captures the low of the SC. That's one liquidity capture. Second drive. The final sell to buy motion comes with the spring, where we take out the low in phase B. We break below that secondary test in phase B before we then trade higher. There's usually an ST. This is your perfect sniper entry. Typically, one of two things. Excuse me. You have either an entry on the spring, which comes with experience and understanding what to look for to the left as a point of interest for buys, or ideal entry comes on that test, ST or test. All right. Because we understand that this is sell to buy, price, might break higher and then retrace, or maybe it doesn't break higher yet, but we get that test here before that breakout and you catching practically the entire move higher. Okay. And then essentially phase D and E are that breakout, that expansion higher from, outside of the accumulation range. Okay. So the low of the accumulation range is established by the seller's climax, the high typically from the automatic rally. You will see both taken out in phase B. You'll see the high taken out from that up thrust action. You will see the low taken out by that ST as an SOW or ST in phase B. And then sometimes, typically, ideally, you will see a spring that takes out even the ST as well before it's like the last hurrah before we trade higher. Now, to finish and continue moving forward with the labels, phase D, this is the bullish trend within the range. So this is before we've broken out of the highs. All right. And SOS is a sign of strength. Bullish movement generated after the phase C test event that manages to reach the top of the range. Okay. Also known as JAC, jump across the creek. It's a creek jump. It's like a break above that resistance or like a break towards that resistance. And then officially when we break above the resistance, it's a jump across the creek. Okay. So this is what we're talking about right here. It's after the spring, price trades higher. You get a retest, mitigation takes place, price consolidates a bit. We then trade higher. Oh, we break above the creek. Okay. That is a sign of strength, right? We get a jump across the creek when price actually breaks the highs, the resistance of the zone. Okay. And then we have a BU, which is a back up. All right. Also called BUEC, back up to the edge. It basically means that we retest the top of the range of the accumulation. All right. So this is the last big reaction before the bull market actually starts. Back up to the edge, back to the creek. All right. So if we're taking a look at this, after getting a jump across the creek, what does price do? We retrace, we get a test on the creek once again, the high of the range once again, and then this thing flies. Phase E is the official breakout of the accumulation where you get yet another sign of strength, which is a higher high beyond the jack, the jump across the creek. Okay, you get another LPS, last point of supply or support, which is usually a fair value gap fill or some sort of a mitigation play to continue higher. Right, phase E, bullish trend out of the range, succession of a sign of strength and an LPS, higher high and higher low, essentially. So that is essentially schematic number one. Now, a lot of what we went over in terms of the jargon and the definitions here are the exact same in schematic number two. The only difference is that schematic number one creates a spring, which is that third drive that captures the low of phase B. And the difference between a schematic number two and a schematic number one is that we create a last point of support and we do not break below the low of phase B. So we'll read through this really quickly. Okay, second variant of the methodology in which the test event in phase C fails to reach the lows of the structure. It usually occurs because current market conditions denote background strength. So there's some sort of context here showing strength, and it makes sense for us to not get a spring. The objective of price is to visit this liquidity zone, but the big traders support the market entering aggressively in purchase. They don't let price go lower so no one else can buy any lower. So they're preventing other traders from entering lower and holding the line, so to speak, to allow for price to really get that move higher. And any sort of, price, the price action that attempts to trade lower, they're buying it up, buying it up, buying it up. Okay. This type of trading range is a little bit more complicated to identify because by not being able to assess the shake action or the shakeout, that terminal shakeout, the bullish approach loses a point of confidence. So you don't have as much confidence taking the entry because there's still that potential of price sweeping the low, or of you getting a better entry. And, it's sometimes going to be a bit more challenging for you to position yourself without seeing the spring. So the primary trading zone is in the spring. Okay. So, when you don't see that in a schematic number two, it can be a little bit more challenging. So, again, if you're going to be taking anything and putting it on your wall, it had better be these. Let me see if I can pull this up again real quick. It had better be these schematics. Okay. Accumulation. Exactly, Brock. Accumulation number one, accumulation number two. It's going to be one of the examples we go over. Okay. Who is ready for distribution? Drop some D's in the chat. As above, so below. One of my mentors told me, Donnie, what you can do and identify in one direction, you can usually do and identify in another direction inversely. All right. D. These nuts. Uh, oh, man. Okay. Let's continue. Right. As above, so below. Write that down in your notes. As within, so without. As above, so below. Distribution schematics. Okay. Practically the exact same thing inversely with slightly different labels. So we're going to get into this. Okay. Schematic number one, take a picture of this or go onto Google, type in distribution schematic number one, print it out, put it on your wall, draw this in your notebook. Okay. In an effort to save time, we're going to go a little bit quicker here. Okay. Schematic number two, same thing as an accumulation schematic number one. We do not get an upthrust after distribution, which is the equivalent of a spring in a distribution schematic. We're going to go into this and we'll pull up the actual the horse's mouth again, the book to dive into it. All right. But schematic number two, same thing. Print it out, put it on your wall, draw the diagram. Okay. So let's jump back over to the book. All right. We now have basic distribution structure number one. All right. So write this down in your notes. Again, illuminate this word. Distribution, the process by which large traders distribute or sell their holdings. This is a transfer from the stronger traders or strong hands to the retail traders, weak hands. Isn't that interesting? At a high point in price, strong traders are distributing to the retail traders or weak hands in the market. Isn't that interesting? The dumb money is buying at a high point in price because of hype, because of excitement, but they're actually weak for doing so because they don't really understand what's going on. So let's talk about it. Similarly to how we have a creek, we have something called ice. Same thing as above, so below with the distribution. It's a level of support for distribution or redistribution structures. It is established by the low generated by the automatic reaction, not the automatic rally, automatic reaction, basically the same thing as above, so below, and by the lows that can be developed during phase B. So if we're taking a look at this, price creates a PSY. We're going to get into what that means. BC, this is buyer's climax, same thing as seller's climax, just inverse. You then get that automatic rally, followed by an ST and a micro sign of weakness. Okay, the low of the range is created by that automatic reaction. Right, this is the automatic reaction after the BC. Change of character indicates the environment in which the price will move soon. The first change of character is established in phase A, where the price moves from an upward trend environment to a consolidation environment. Here we are, price is bullish, life is good, Bitcoin's hitting new all-time highs, and then boom. Oh, wait a minute, right? Price is slowing down. It's the end of the world. We're going into a bear market. There's your change of character. Okay. It's the start of the distribution. It's not the end of crypto. It's not the end of whatever it is you're looking at. It's the start of distribution. The second change of character is set from the high of phase C to the low of the SOW, sign of weakness, in which price moves from consolidating to a downtrend. It's right here. Okay, we go from bullish to consolidating. We go from consolidating to a bear trend, markdown. All right. So let's talk about it. Phase A, stop the previous trend. Write that out. Phase A for distribution is to stop the previous trend, the bullish trend in this case. So PSY stands for preliminary supply. Okay. Preliminary supply. It's the first attempt to stop the climb that will always fail. Isn't that kind of similar to PS, preliminary support? Yes, it's the same thing, in fact, just inverse. So here, we're super bullish. Super bullish. We create a high. Price gets a little reaction. And we just blow through it again. There's your PSY. Okay. You'll get sequential PSYs. Okay. This is technically a sequential one. This is technically a sequential one. You won't really know until you get that change of character, that BC and automatic reaction, followed by the ST. You won't really know we're in an accumulation or a distribution in this case until you get that, which is why phase A is so important. It's the defining phase of the start of a distribution or an accumulation. So BC, buying climax, right? We already kind of talked about this. Climax action that stops the upward movement. Price trades higher, we get that BC, price aggressively sells off. Not a little shy pullback, not a little fair value gap fill like we're talking, someone might look at this as a market structure shift type of sell-off. Okay. Automatic reaction. This is a bearish reaction, bearish movement that sets the low of the range. Again, your buyer's climax is setting the high of the range. Your automatic reaction is setting the low of the range. The same thing we were looking at in an accumulation. In phase B, you will see an attack on both the low and high of the range. It's really key stuff. Okay. You will always see an attack on the high and low of the range without fail in phase B. ST, secondary test at the level of demand in relation to climax action. Establishes the end of phase A and the beginning of phase B. So that's before we get a break below the automatic rally, which happens in phase B when we get the construction of the cause. Once again. So construction of the cause, we have an upthrust, okay, which is the same event in an accumulation as the upward action. Temporary breakout of the resistance and re-entry in the range. This is a test at the high generated by the buyer's climax. Okay. You then have an MSOW, a minor sign of weakness, a micro sign of weakness. Minor is the correct way of referring to it. Sometimes I'll say micro. It's the same event as the secondary test in phase B or ST as SOW in accumulation. It's a temporary breakout of support and re-entry to the range. This is a test at the low generated by the automatic reaction. So we get that ST, price goes, we get that minor sign of weakness. We break below the low of the range. Price then very quickly goes and takes the high of the range. How many times have you as a trader looked at this and been like, oh, we're bearish, market structure shift. I'm selling the next retracement into this order block. And then you get smoked and both highs get smoked. And you're like, okay, I clearly don't understand what I'm doing. Right. It's simple. It's actually just distribution, man. It's not that you were selling at the wrong time. You just didn't understand where we were in the distribution. You're selling at the right time, selling here. That's the middle of the distribution. If you just understand where we're at, you're technically in a great spot to hold for that markdown. But you sold too early and without understanding where we were in anticipation of that upthrust or that UTAD, upthrust after distribution. So continuing, phase C, the test, UTAD, upthrust after distribution. The same thing as a spring inversely, okay? Same thing as a spring inversely, all right? It is a test in the form of a breakout of the highs of phase A and phase B. Your UTAD test, this is the upthrust after distribution. Or sorry, yes, we just read upthrust after distribution. This is the test of the upthrust after distribution. Okay, it's an upward movement that goes up to check the level of commitment of buyers. All right, so that's basically your entry opportunity after getting a UTAD. So UTAD, see price spike higher above the UT. All right, here's that retracement, that ST for selling opportunity. Again, the best places to enter sells are here and here. The UTAD comes with a lot more skill and understanding what to look for to the left. The ST is a little bit easier if you understand where we're at in the whole schematic, and it's a safer one. And then you get that markdown and you're positioned in that move respectively and accordingly. Phase D is the breakout, bearish trend within the range. M, SOW, capital M, SOW is major sign of weakness. Bearish movement originated after the phase C test event that manages to reach the bottom of the range, generating a change of character. Okay. Because again, technically, you look at this, people are like, oh, we're bullish. And it's like, actually, no, we're not. We're seeing a change of character. We are, in fact, bearish. It's a distribution, right? And so on and so forth. We break below the ice. The ice is shattered. Okay. And then the last point of supply is LPSY, last point of supply. So these are the decreasing, highs or lower highs. We find that a bearish movement towards support. Phase E is the full-on breakout. It's a succession of lower lows and lower highs, or signs of weakness and LPSYs. Distribution schematic number two, again, fairly similar, only difference. Okay, first drive, second drive, third drive, which is higher than the first one, usually in number one. Number two, we're getting a failed higher high above the UT, and then we're selling off. Second variant in the methodology, in which phase C fails to reach the highs of the structure. Inverse reasoning for accumulation schematic number two denotes a greater weakness in the background. There's context. There's something that is showing greater weakness previously, or there's not, and it's just the market unfolds that way. Or maybe it took so long. Okay, again, cause and effect. The law of cause and effect obviously being very significant, and then the law of what was the other one? Hold on, let me pull it back up. We had three we went over earlier. Effort and result. That's what it was. I knew it was effort and something. Effort and result. Okay. So that's it's maybe you see a progressive long-term distribution. There's like effort but not really seeing much. Okay. And so that could be what denotes the greater weakness in the back end, reading between the lines, so to speak. Okay. Price tries to reach liquidity that's above the highs, but anybody who's or the big fish that are already positioned in shorts prevent it. All right. Because again, money is what's controlling the market here. If you have the vast majority of traders that are all taking buys, but there's a couple big fish who are taking sells and they're suppressing price, you know, we know the story. We know what's going on, right? Smart money. So Bitcoin all-time high distribution was a number two distribution. Which all-time high are you referring to? The 69,000 all-time high or the 65,000 all-time high from last bull run or the most recent all-time high? So again, these schematics definitely, certainly are something that you want to print out and actually have visible to you anytime that you're trading. Okay. Maybe you're out and about, you're trading on the go. I get it. Maybe you have the pictures on your phone. You can pull them up, refer to them whenever you'd like. But this is really powerful stuff. And now I want to get into some examples. And before I do, this is what I was referring to briefly earlier when I was talking about market cycles. And this is the illustration of market cycles. So the same way that we have four phases, you have accumulation, markup, distribution, markdown. There's also a way of looking at the market where the start of a cycle will always be accumulation. Write that down in your notes. A market cycle will always start in accumulation. It will then be followed during the markup, typically, with a reaccumulation, followed by then a distribution, then a redistribution, to then start the whole cycle and process over again with a brand new accumulation. So you can kind of see the legend on screen here. You can print this one. You don't have or screenshot this one. You can't find this one on Google, to my knowledge. Maybe you can. I created this one, so maybe that'd be kind of cool if you could Google it. But you'll see points of interest entry areas. The places you want to be entering in an accumulation are you can either enter on the spring or the test of the spring. You have that breakout above the high. You're getting that next LPS, last point of support. Okay. You get the reaccumulation, which also creates a spring and a test. All right. The spring usually gets a little test here, and then we'll get a jump across the creek, which is the high of the range, followed by sometimes a deep retracement. Okay. And then same thing, vice versa. You want to sell the test of the UTAD. Sometimes there's a little redistribution schematic that's more in detail, similar to this. And there's schematics that you can study and learn for both reaccumulation and redistribution. I'll give you guys a couple. But who's getting some value so far? Who's like, all right, cool. We've been here for, dang, it's been that long. Maybe you're like, wow, it's been a while already. Yeah, we've been here for since technically we started the session. It's been almost 2 hours. Started the session a little bit early, like open the Zoom. I mean. But in terms of learning material, we've gone over quite a lot, and it's been just about an hour and a half. So who's getting some value so far from the session? Okay, if you haven't already, like I said, go ahead, feel free, take a picture, take a video of the session, post it on Instagram, tag me. All right, I'm happy to repost, happy to connect after the call as well. And I really hope that you guys are taking the training and going to apply it, because it's one thing to be here. It's another thing to actually go and see this stuff on the charts for yourself. In fact, let's actually get into some examples, because these are actually all these examples, by the way, have been over the years. You'll see different color candlesticks in some of these screenshots, different eras of Donnie, right? The different eras of Donnie you will see in these screenshots and the different colors of the candles. You'll be able to find this recording on YouTube. On YouTube. I'll be posting it on YouTube. So if we continue to look at some examples here, all right, this is an example from GBP USD, I believe. I don't know when this was. It was in an era of me using turquoise and black candles. And I'm pretty sure this is on like a 5 minute or a 1 minute chart. Okay. And so if we're taking a look at this, this is currently accumulating in a 1 hour point of interest. So there was a markdown during London session. Again, remember that cheat code I was telling you guys about, the three drives. 1, 2, 3. You can see those labeled by these little blue thingies. So here we see a major sell-off, which is saved. We get an automatic rally, ST in phase A. We get the top of the range established. Price then sells off. We take out the low of phase A. There's your ST. Get a little bit of a rally here, followed by a spring, which is sweeping the previous low once again. Trade higher, test. There's an entry opportunity for you, right? Imagine taking this trade. This is in a 1 hour time frame point of interest on a smaller time frame. If you know to take this trade, your stop loss is beneath this low and you're targeting these highs. What does that risk to reward look like? It's looking pretty good. That's just to the most recent high from, London session. It's got to be like a 1 to 10 right there. Okay. You then get that last point of support. Price gives you the sign of strength, and then we're just printing higher, printing higher, printing higher. Okay. New York session mark up, London session mark down. Okay. This is a schematic number 1 example. Schematic number 2 example. This is a trade I took on Jur 30. I actually think this might be on my Instagram page, potentially. And is a 15-minute time frame accumulation. So you have your preliminary support. Okay. You still kind of get 3 drives, even if we don't get a spring. You would look at the PS as your first drive, seller climax, second drive, STB, third drive. With ST as a sign of weakness. Notice how, again, the low of the range is established. Well, let's go back to the notes here. Okay. Let's read it from the book. Okay. Automatic rally sets the high of the range. What is setting that low of the range? It's the SC. Doesn't actually say it in the message here, but that's setting the low of the range. So if we pull up the example again, your SC is setting the low of the range. Your automatic rally is setting the high of the range. You have your STA. You get a sweep of the high, sweep of the low. Price trades higher. Here's an entry opportunity for you. If you were able to gauge that we were in a type 2 schematic, that's a beautiful entry opportunity. And even if not, price gives that sign of strength. We return, last point of supply, relatively equal lows. We get another high. Price then swipes all the lows. Here's your entry off of this point of interest. Okay. And look at the risk to reward on this trade. It's got to be, it's pretty good. 24-point stop loss for a almost 300-point take profit. Approximately a 1 to 15. I can share the slideshow for sure. 100%. Right? You have your sign of strength really breaking above the range. There's your LPS. Okay. Testing. What are we testing? The top of the range. So you could be buying this, 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 right? Look at the point of interest you return into, a little fair value gap. Okay. This is just to the first high that's on the screen. That's not, this is like, we're just getting started to break out of this move. Like this is a 1 to 15 at the top of the range, not the top of the accumulation range. That's already like a 1 to 8 though. Look at another example. All right, this is a side by side screenshot. I mean, this is like one of the most picture perfect examples I've ever traded personally. Okay. Another accumulation schematic number two. Pretty ugly. Probably not going to spend a whole lot of time on it because there's some better ones I want to show you guys. But a couple quotes that I want to share as we get close to the end of the session. And these are some really banger, like picture worthy. Like if you were going to take a picture of a slide and hypothetically post it to your story and tag me, it would be this slide or the next slide, or take a video and you're gonna post it, tag me on Instagram. It'd be one of these ones. This would be a good one. But the market is never obvious. The market is never obvious. It is designed to fool most of the people most of the time. Think about that. It's by design, man. You're in the matrix. Wake up. Okay? The market is never obvious. It is designed to fool most of the people most of the time. Absolute nugget from your boy, Richard. Second quote, do not trade based on tips or news. Learn to recognize the footprints of smart money in the tape. Learn to follow the footprints of these individuals. Okay. I actually have a couple more. I don't have a slide for them, but I'll pull them up nonetheless. I did mention one earlier. A profit is not a profit until it is realized. The second one I have for you guys is the successful trader acts according to what the market is telling him, not what he wants to believe. Think about that one. The successful trader acts according not to what he wants to believe, but what to the market, or but to what the market is telling him. Like, what is the market telling you when you take a look at the Bitcoin chart on the daily time frame right now? Let's pull it up. Let's talk about it. Okay. So, a couple examples, distributions. I will be honest, and I'm going to give you guys a tip. In fact, Nick Gomez mentioned this tip on yesterday's live session as well. He did a live session yesterday. I am way better at identifying accumulation schematics. I'll say it. I'll own up to it. Okay. I didn't have time to find any distribution schematics. That's why there's no examples. I could definitely find some, and we'll take a look at one that I have that's not marked up that we could take a look at together. Okay. But I am way better at looking at accumulation schematics. So, cheat code, if we are in a consolidation point at a high, and you're like, wow, this is crazy. I'm looking at the distribution schematic, which is over here. I printed it out, put it on my wall, and I'm having too hard of a time with this. Cheat code, go to the settings, invert the chart, and now look for an accumulation. Oh, here we go. Okay, this is making sense. Type 2 schematic. All right, one, two. Actually, maybe this is a type 3 schematic. One, two, three, test, fly. Okay, yes, this is accumulation type 1. Perfect. All right. It's actually a distribution type 1 because you inverted the chart. You just had a hard time seeing it with your eye. Believe it or not, most traders have a way easier time buying and identifying buying setups as opposed to sells and selling. True story. So, taking a look at the daily time frame on Bitcoin. All right. Taking a look at the daily time frame on Bitcoin. What are we seeing here? You guys tell me in the chat. This is unlabeled. We're looking at the candlestick chart. We could look at the line chart. It will look very similar. Y'all tell me, what are we seeing here? Consolidation, accumulation, for sure. Three drives. One, two, three. Let me annotate. I got you. There we go. Now try. Good. I like it. Right? Markdown, seller's climax, automatic rally. STA or B? There's a couple ways you could look at it. A. Well, let's look at the schematic for a point of reference. I'll delete this, but I'll pull it back up in 2 seconds. So typically, your ST is here creating your ST in phase A is creating a higher low followed by a higher high, typically. And then your ST is that low beneath the seller's climax. So what are we seeing? STB. The only thing that isn't picture perfect with this example is a capture of the high of the automatic rally, right? So is that absolutely crucial? Not necessarily. You're not going to get a picture perfect schematic every time. Is it ideal? For sure. But to be fair, this was a massive move. Like we saw this V-shaped recovery on Bitcoin, and it was a 20% bounce for almost 16, 17,000 pips. We then got an ST. We did get a test of the high. We didn't break above it, but we did get a test of the high, followed by that STB. We then get a movement higher. This to me, I would be identifying this as the spring. First drive, second drive, third drive. Or this was preliminary support, seller's climax. You have your STB here. Okay. And we're either going to create a type 2 schematic or we get a crazy 72K spring. But what I would say I'm leaning more towards is this being a type 1 schematic and it's already played out. Not to say that 72K is off the table. If we got that, then, you know, that would mean that we're looking at this a little bit incorrectly in terms of the schematic. But what I see so far is very, very bullish, this being spring. And if we combine this with volume, the volume indicator, okay, I don't know what this RSI thing is. Let me delete that. Look at the amount of volume that comes in at the SC and the spring. We haven't really talked much about volume, and this is why I'm thinking we're going to need to do another call maybe next Wednesday on Wyckoff. But we have the major sell volume, major buy volume at the spring. This is pretty typical for a spring because they'll test it and then they'll buy it back up very, very, very quickly. Okay. If we actually look at it in the book, we won't get into it in too much detail, but there is a whole section on volume. Where are we here? Let's see. Importance of volume, harmony and divergence. Yeah, notice here, this is like a cool little snapshot of it actually. So you have high volume for an SC, high volume for a spring, and then can sometimes be high volume for the breakout as well. All right. So something to consider. Something to consider. But I would say that this is looking very good as an accumulation schematic number one, this being the spring that we just saw at the beginning of April. Could I be wrong? For sure. 100%. Maybe we're looking at it slightly incorrectly, and this is, in fact, the ST in phase B, and we're about to either get a test on that to go higher, or we get a sweep of it. I wouldn't marry the idea of us getting a sweep of it, though, because either this is already a spring or we're going to get, a test on it. I think those are the two more likely scenarios. It can also be a redistribution, yes. We didn't talk much about it, but there are schematics, and I actually want to give you guys something. Those of you guys that are on the Zoom that made it to the end as a little token of, success for making it to the end. I want to drop something in the chat for you guys that just you guys that are on the session and made it to the end are going to have. This is a PDF that goes into all the different types of schematics. It actually goes beyond just number one and two. There's four for distribution and accumulation. And there's also, if I pull this up, the reaccumulation and redistribution schematic cheat sheets in there. This is what it looks like. Okay, so you have all of these. You can download the file. It's in the chat. There's four schematics. Don't focus too much on three and four. Focus on one and two for now. Okay, we're going to do more calls. We're going to do more trainings. All right, but you have different types of reaccumulation. Schematic number one for reaccumulation. Schematic number two for reaccumulation. One for redistribution. Two for redistribution. Okay, so as a token of success for you making it to basically the end of the training, you can save that cheat sheet. This is one that I've never shared anywhere before. I didn't make this cheat sheet, by the way. This is just one I'm sharing. But it's good stuff for sure. Another accumulation I want to show you guys, the last one before I call it for the day. Oh yeah, distribution. Hold on, we got to show distribution some love here. Classic distribution schematic that I can show you guys that's picture perfect textbook is the first high that we saw in Bitcoin in 2020 and 2021 bull market. Okay, we had, oh, this is a logarithmic scale. That's why it was looking weird. All right, here we go. So here we have what looks to be the start of a distribution schematic. Okay, and again, because I'm not the best at identifying distribution, I like to invert the chart personally, just a personal preference thing. So you have the seller's climax. Okay, we didn't really get a automatic rally with a UA unless you're looking at this on the smaller time frames, followed by an ST, followed by a spring, followed by a test, right? And if we invert the chart, there's your distribution. Okay, there's the selling opportunity, perfect fair value gap fill. This is a daily time frame. So obviously, we're not talking about day trades here. This is just over the course of 3 months, essentially, right? Almost 3 months. So there's your distribution example. We'll go into some more another day, but the last one that I want to show you guys, really clean. I think I had it here. Hold on, where is it? Is actually this one. It's not in the slides, but it's actually on Tezos. And let me actually show you guys just on the chart real quick. Hold up. So way back at the end of 2020 and into early 2021, there was this example that I drew up that I didn't look at for a long time, but this was a beautiful accumulation schematic that marked up beautifully for huge percentage ROI on Tezos. But you have first drive, second drive, third drive, price marks up, re-entry, price marks up, re-entry, price marks up. We test the top of the range, re-entry, and this thing just absolutely took off. Really, really clean. So I won't get into all the labeling, but guys, with that being said, we're at the top of the hour. If you got some value, okay. Actually, let me do this real quick. We got to get one for the gram. 1 second. So we just wrapped up the first boot camp and training for Wyckoff. Had an absolute blast. Guys, if you had some fun on today's session, you got some value, go ahead and absolutely blow up the chat for me real quick one time for the kid. Okay, you guys should have been here live. It's all good. We got the recording for you. All right, we had a lot of fun. Great training, great time. Looking forward to the next Wyckoff session. We're going to do another one of these. I'm thinking next Wednesday. We shall see. You guys let me know. You guys let me know. And if you need the recording, don't hesitate to reach out. I'll send it to you. But cool. Hopefully you guys got some value. Go apply this thing, man. Go look at some of your favorite pairs, apply this, back test it, watch back this recording. And guys, I really hope this was full of breakthroughs. When you start to understand, we didn't have time to go into it today, but I'll get into the fractal nature of Wyckoff the next one we do. And it's really crazy. It's really, really crazy stuff. Where can you get the Wyckoff methodology book? You can get it from my Instagram. This particular reel, if you comment books on that reel, it'll forward you to a link. It'll just ask you for basic info, and then it'll forward you to your Google Drive, the Google Drive destination. And from there, you can download the books. There's 3 books, 2 psychology books, and then 1 on Wyckoff. But yeah, fam, enjoy the rest of your week. Much love. I had a lot of fun on today's session. I was really fired up for it. This is truly a revelation in smart money. I really truly believe that it's something that is very seldomly understood, but can be a true game changer for many of you. It's just as much as it was for me with my trading. So go out there, apply it. Let's keep in touch. I'll keep you guys posted with the recording. Number one, you'll get an email, okay, with the recording. People that didn't attend live but that registered will get an email with the recording. And if you have my YouTube, you can stay tuned there. It's the live stream recording will be up there pretty much immediately as soon as we end the session. And I'll also keep you guys. Do you guys want me to keep you posted for the next session as well? Like, would you want to receive an email notification, or obviously I'll post about it on social media as well. Do you guys want me to keep everybody in the loop via email? Okay, perfect. Sounds good, guys. Sounds good. All right. Well, much love, everybody. Enjoy the rest of the week. Let's have a great trading day tomorrow. If you're part of the community, I'll be live trading tomorrow morning. And if you're not a part of the trading community, but you want to be a part of the community. We do live trading 2 times a week, Tuesdays and Thursdays for New York session. It's a lot of fun. A lot of people make a lot of money during New York sessions with trade ideas, not just my sessions, but other educators, and we have a lot of fun. So if you want to be a part of that, you can feel free to reach out to me on Instagram. But with that being said, much love, fam. Peace out, and catch y'all tomorrow.